Good afternoon. I am Suruchi Satsangi, presenting my lecture on financial management. Now, the meaning of financial management. Financial management is the two term financial and management. Financial means the related to the financial activity. Management is to manage the activity of the company. Financial management comprises the planning, organizing, directing, coordinating, and controlling of all the activities related to the finance. Now, there are two aspects of financial management, or we can say that the functions of the financial management is the procurement of funds or utilization of funds. Procurement of funds is to sell, it's to get the funds from the long term sources or short term sources, and whereas utilization of fund is to utilize the funds by short term investment or by long term investment. Now, there are the three decisions of the financial management, that's capital structure decision, which is also known as financing decision, working capital management decision, and investment decision, which is also known as capital budgeting decision. Now, capital structure decision or financing decision includes own funds and loan funds. Working capital management decision includes the current liabilities or current assets. Investment decision, which is also known as capital budgeting, which include fixed assets or investment in fixed assets. Now, the objective of financial management. There are the two objective, that is primary objective or secondary objective. Primary objective mainly focus on the wealth wealth of the shareholder. The primary objective is to maximization of the wealth of the shareholder. It is the long term objective, and it is also maintain the balance between between the risk and the return, whereas secondary objective is to maximize the earning, and it is the short term objective, and it mainly focus on to earn high profit by taking high risk. Now, the difference between wealth maximization and profit maximization. Wealth maximization aim is to increase the value of the shareholder or stakeholder of the company, whereas profit maximization is the main aim is to increasing the profit of the company. Wealth maximization focuses on the increasing the value of the stakeholder or shareholder of the company in a long term period, whereas project profit maximization is to main focus on the increasing the profit of the company in short term period. Risk wealth maximization considered the risk and uncertainty in the business, whereas profit maximization does not consider the risk or uncertainty in the business. Now, the finance functions of finance decisions are of the combination of three decisions, or we can say that is the functions of the three decisions, that is investment decision, finance decision, or dividend decision. Now, in investment decision, capital budgeting, working capital management are included, and in financing decision, cost of capital, capital structure decision, and leverages are included, and in the dividend decisions, dividend policies and retained earning are included. Now, the scope of the financial management. Financial management involves the estimation of long-term financial requirement as well as short-term financial requirement. Financial management is also taking decision regarding the optimal capital structure. Financial management also concern in the selection of the best source of finance, in such as equity shares, debentures, preference shares, etc. Now, the financial management also involved to maintain the liquidity in the business for smooth functioning. Financial management aim is easily available of the resources, so the management ensure that the fund should be available whenever the company or whenever the firm is needed. Now, the financial management is aim to optimum use of funds by maintain the balance between the liquidity and the solvency. Now, the capital budgeting decision, it is the process of making the investment in fixed assets by taking decision in capital expenditure. It also involves the planning and control the capital expenditure, and it is also the process of deciding whether the long term project give the benefited for over a period of time or not. Now, the capital budgeting, when the company is choosing the or going for the capital budgeting, then company should know that company have to invest the huge amount of funds in the project, and it is not for the short term, it is for the long term period. And company can't take the project reverse and can't take the project back if once invested in one project. It is irreversible, that company cannot or can't take it back. When company choose the capital budgeting, then company will see the long term effect. Now the capital budgeting process, it's a first that company should first identification of the various investment, that company should first identify the various investment, and when the company identify the investment, then they have to screening the various resources. After the screening, they have to evaluate the given proposal, and after the evaluation, then they have to fix the property, and when the company fix the property, they have to take the final decision or final approval, and after that they can implement the plan. Now the capital budgeting decision. Capital budgeting techniques are of two types, that is traditional technique or modern technique. Traditional technique is also known as non-cash discounting technique, whereas modern technique is also known as time adjusted technique or discounted cash flow technique. Payback period and average rate of return are included in traditional technique, whereas discounted payback period, net present value, internal rate of return, and profitability index are included in the modern technique. Now the payback period. Payback period is that period in which the entire amount of invested is expected to be recovered in the form of cash. It is the actual payback period which is less than the predetermined payback period, then the project will be accepted, and if not, then project would be rejected. If payback period is lesser than the predetermined period, then the project will be accepted. Now accounting rate of return or average rate of return is both are the same. It is the rate of return that the project is giving without considering the time value of money. This method considered profit and not cash flow for calculating the rate of return. Now rate of return is calculated as average annual earning divided by average investment multiplied by 100. In which average annual earning is calculated by total earning divided by the number of years, and average investment is calculated by the total investment of the company, which is divided by the 2. If average rate of return is higher, then company should accept this project. Now net present value. Net present value, discounted payback period, profitability index, and IRR are the modern technique. Now the first, net present value. Net present value is the value of all the cash inflow and cash outflow. And net present value is the difference between the present value of the cash inflow and the present value of cash outflow. It also indicate by the investing the project of cost today, then the company have to check the how much extra company getting in today's value. If NPV is positive, then net present value is positive, then the company have to accept this project, then company is advised to accept this project. Now the profitability index. Profitability index is the contrast of the net present value, and it is also called profit investment ratio or value investment ratio, and it is calculated by the present value of cash inflow, which is divided by the present value of cash outflow, and it is necessary tools for the ranking of the project, as it permits to quantify the amount of value generated per unit of investment. It also indicates that every 1 rupee invested in the project, that shows that how much we are getting in today's value. If company invested 1 rupee, then company should know that how much company get in today's value. If the profitability index is high, then company is advised to be select this project or accepted this project. Now the discounted payback period. Discounted payback period is that time period which shows that how the company recovered the principal amount invested, the time value of money. It is related to the time value of money, and it is same as the payback period, but in discounted payback period, first we have to calculate, or we have to calculate the future years cash flow are discounted then cumulated. If the discounted payback period is less than the predetermined payback period, then the project have to be accepted by the company. Internal rate of return, it is the rate of return in which the net present value of the project is zero, and it is also called discounted cash flow rate of return. Now they are in the internal rate of return, there are the few steps that have to be followed. That first you have to find out, the company should have to find out the factor. Then when company find out the factor is calculated by initial investment divided by the cash inflow. Then company first find out the find out the factor, and after that company have to find out the net present value is positive. First they have to calculate the positive net present value, and then negative present value, and then they have to apply the internal rate of return formula. Internal rate of return formula is base factor. Base factor means the positive discounted rate plus positive net present value, which is divided by the negative present value, and multiply by the whole positive and negative net present value multiply by the difference in percentage. Then company get the internal rate of return. Thank you, and sorry for interrupting, and thank you for giving us such a golden opportunity, and it's really nice to make a video, and I really enjoyed it. Thank you so much.